What's up, everybody? Having an awesome week so far, I hope. It's Market Report Tuesday, February 15th. I hope you all had a happy Valentine's Day. Thank you, everyone who sent me all the birthday greetings and well wishes. I appreciate it so much. Lots to talk about this month. We've got inflation, we've got news from the Fed, and of course, mortgage rates. So let's get started. As we do these market reports together, what we're trying to really focus on is the real estate market from a macroeconomic level, the big picture. And what are the biggest things happening? Well, one thing that's the topic of every conversation, I guess, in economics is inflation. What's being done about it? How bad is it? Is it transitory? We're going to dig into that a little bit in this market report and really how that affects us in real estate, or at least thinking about it from the real estate mindset. And I think an important thing to keep in mind is that your real estate asset or assets, your house, is a great hedge against inflation. As the cost of living continues to rise, locking in the cost of housing at today's cost versus having to ride the rising cost of rent or the rising cost of purchasing a home, that's a tremendous benefit to your bottom line going forward. This bit here from Investopedia from Mark Cusson, he explains this a little bit better. He said, real estate is one of the time-honored inflation hedges, okay? It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. This is a really game-changing concept for a lot of folks. Again, you're locking in that cost of housing, but better yet, your asset grows in worth while that monthly cost to you remains the same. Now, obviously, this doesn't account for rising utility bills or maybe a slight increase in your property taxes. However, the point still remains the same. And I'd kind of like to give a better picture of that with this next slide, this graph. This is how rising home prices have measured up against inflation, going back here all the way to the 1970s. What we've got here with the blue bars is our inflation rate. And of course, our green bar is the rise in home price appreciation. So looking at this, now remember, think about this as an investor, okay? Where do you want to be? In an asset class that outperforms inflation, right? Well, except for the 1980s and the 2000s, where real estate and inflation were neck and neck, real estate outpaced inflation in each of these other decades. Well, what the hell happened in those 2 decades, in the 80s and the 2000s? Well, we had the crazy high interest rates, carrying over from the late 70s. We also had the savings and loan financial crisis. And then in the 2000s, we had the dot-com bubble, along with a subprime mortgage crisis. So again, not accounting for those 2 decades, you've seen the same thing of outpacing inflation each year. Now, again, talking about rent, the cost of living with rent. If you've caught any of my previous market updates, you remember me showing you that's something that's risen year after year. Leases are renegotiated typically every 12 months, and those rent prices increase each time. This is what I'm talking about. A fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment. Sure, property taxes will rise and other expenses may creep up, but your monthly housing payment remains the same. That's certainly not the case if you're renting. That's according to Bankrate. So backing up, if you're a person who's renting currently and is sitting back waiting and thinking, I'm going to wait and see what happens with property values, and I'm going to pull the trigger when I get a better idea of what the housing market is going to do. Well, all the data that we've seen, all the forecasts that have been collected by me for these market updates, by economics, they all show that house prices are going to continue to increase. We're going to keep seeing increases in mortgage rates. We're going to keep seeing increases in rental rates. And what does that all mean by the end of the day? That to rent is to sort of be stuck in the worst of both worlds. You're taking on the burden of increased rent costs while facing only more and more expensive home purchases and more expensive home loans when you decide to do buy. There's a graph that shows those rent price appreciations, the increase in rent, and how it's outpaced inflation, as you see in just about every year going back to 1973. For the most part, rental prices are jumping up faster than what inflation is increasing. Tenants in those years, they didn't have their housing costs locked in, and they paid more and more for where they lived, and they didn't get to have an asset that was increasing in value at that same time. We'll wrap up with this. And this will be enough on it. But Forbes magazine said homeowners are shielded from mounting rental prices because their cost is fixed, regardless of what's happening in the market. Tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times, just like we've been saying. But how much of a rise in asset worth of your home are we really talking about here? Well, let's look at some cumulative surveys. This is the home price expectation survey. And this was done, I think, this last quarter. And according to it, they divided all of the panelists up into three categories. You see here, all of them all together, then the optimists versus the pessimists. And this is what they show. The cumulative house price appreciation, according to the optimists, will be over 62% over the next 5 years, an average of 12.5 per year. We see over here kind of what the pessimists are saying, just an average of 4.7 per year. I kind of look at this as a good, better, best thing, what all the panelists and all the economists are saying. But let's talk a little bit about mortgage rates. And I want to start right here. This was as of February 3rd, a couple of weeks ago. This is direct from the horse's mouth, Sam Cade with Freddie Mac. This is a little bit longer quote. I'll cut some of it short. He said, "The economy lost some momentum in January, leaving mortgage rates unchanged from last week and relatively flat for a third consecutive week. This stagnation reflects the economic impact of the Omicron virus, which will subside. As the economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that home buyer demand continues to be elevated as supply remains low, driving higher home prices." So now, some things to know real quick. This statement came out, Friday. The day before the jobs report, Friday of that week, which was super positive. Okay, so prior to then, this quote was issued, and since then, with that awesome jobs report, that's just going to continue to further encourage the Fed to take action, raising those Fed fund rates next month in March. So expect to see some mortgage rates jumping up. Be ready for that. Let's take a quick look. Here's a track of our mortgage rates. We sit right here now at 3.55%. And just as we've been predicting, we're on a rising trajectory of mortgage rates. This is a visual that shows it across the last 2 years back into 2020. This is a wider view going back to 2018. Again, showing here what the history of our mortgage rates have been. And here's some reference for you. Here, today's rates, again, 3.55%. This is how that measures looking back across the last 40 years of 30 fixed rate mortgages. Some perspective on that. Sam Cater said, "As mortgage rates rise, we do expect some moderation in housing demand, causing price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive." It goes on to say, in 2022, we expect purchase originations to grow to 1.9 trillion in 2022, while refinance activity is anticipated to decrease from 2.7 down to 1.2 trillion in 2022. Okay. Now, one thing I think it's cool to see here is the distinction that he made between originations and refinances. It makes sense, right? These are two different mortgage markets. And they behave a little bit differently in times like this. As rates rise, more people try to take advantage of that lower rate while they still can, and they refinance their house. And then that kind of tapers off as the rates go up. Everyone took advantage of it while they could, and then that market starts to constrict. Now, if you take advantage right now of that 3.5%, maybe even 4% by the time we get to this summer, that's still a very favorable rate compared to, as you see here, the last 5 decades. Pretty much between 2010 and 2020, we've really only bounced between 4.5% and 5%. Very good financing, comparatively speaking. And I think that's going to get higher still, but still very low, historically speaking. Now, the last two slides I want to show you are really kind of more to educate you on how this kind of can be predicted, managed, but even better yet, predicted what's really going to happen to interest rates at a given time. So class is officially in session here, all right? This is a 10-year treasury yield. Most of you know what that is, but just in case, for those of you that don't, this is the return that a government treasury bond, or a T-bill, they're often called, what that return is. Now, what is a treasury bond? It's a government IOU that they issue, what they do to pay for all their spending. Okay. Now, of course, they don't just borrow the money; they do it with a little bit of interest, and the return on that borrowed money relative to the cost of purchasing that government bond is called the yield. Governments have they've been doing this since the 13th century. I think it first originated in medieval Italy. But anyway, as we know, and as we see here, that rate on the 10-year treasury bond has continued to skyrocket. And right now it's steadily heading towards 2%. And why is this important? Because for the last 50 years, the track record, as you see, between the 10-year treasury yield and mortgage rates has been just about symbiotic. Wherever the 10-year treasury yield goes, there goes the mortgage rates. Now, the Fed raising or lowering rates doesn't control mortgage rates. It kind of really just only hopes to influence it by increasing or decreasing the money supply. But instead, what we want to watch to predict mortgage rates is the 10-year treasury yield. We'll wrap up with this. Mortgage rates hit their highest level since March of 2020, and they've been leading to the slowest pace of refinance activity in over 2 years. So anyway, that's all I've got for you guys. I hope you have a great week. There's lots going on. We've got earnings reports coming out this week. I think Walmart, Nvidia, Roblox, DraftKings, those come out. Part 1 of Kanye's documentary on Netflix hits this week, I think on Wednesday. So does the documentary on Boeing. It's called Downfall, the Boeing 737 scandal. I also read that Meta, Facebook, they're having an all-hands meeting today to discuss the state of the metaverse. Anyway, NBA All-Star Weekend kicks off this Friday, so really cool stuff. That's enough for me. Hope you all have a great week. I love you all. Thank you again for watching, as always, and we'll see you next month. Bye-bye.